In this example, I'm going to add an additional element to the net present value scenario, and that is working capital. So in the original scenario, the only cash flow that was involved was the initial purchase of the machine, the initial investment, and the savings in operating costs. In this scenario, what I'm assuming is not only are we going at the beginning of this 8-year period to spend the $225,000 to acquire the machine, we're going to need some upfront working capital. And so what I'm going to assume is that I'm going to be setting aside or putting into the project $5,000 in cash over and above the cost of the machine. Now, what I anticipate is that at the end of the 8 years, I'm going to be able to recover that working capital. So everything else is the same, still no salvage value, useful life of 8 years, required rate of return of 8%. But if you look then at the present value calculation, on day one, there are two cash outflows: the purchase of the equipment and the investment of the working capital. Both of those take place on day one, so the present value is equal to the cash flow. Then you're going to have the years 1 through 8 of the savings. That calculation is exactly the same. Using the tables, it's the factor from the present value of an annuity table for 8 years and 8%. The other new piece is that at the end of the 8-year period, we're going to get that $5,000 back. So you'll notice that what I've done is I have the $5,000. This is a one-time recovery. This is not an annuity like the 48. And then I have used the factor from the present value of a lump sum table for 8 years and 8%, and the present value of that is $2,700. Then my net present value becomes the sum of all of those, which is $48,556. And then I did the same calculation using Excel. The investment and working capital are the same. The payment, but the present value is the same as the cash flow. The annuity is the same calculation that I did in the previous example. And then the working capital recovery is still the present value equation, but you'll notice now instead of having a payment, we have the $5,000 future value. And I come down to a number that's very similar to the one with the tables. This is also similar to how you would treat a salvage value. If we had a salvage value, you wouldn't have the outlay like the working capital at the beginning, but then you would present value that salvage value at the end of the life, and it would be a one lump sum. So actually, let me just walk through that. Let's copy this and paste it. And let's assume that we have a $10,000 salvage value at the end of the life of the asset. Then let me fix these. This will be the 225. This will be the 5. This will be the 48. And this. Let me plug these in. Should have done this ahead of time, sorry. And then here we're gonna do this. And here we'll just do that. And then the working capital recovery, we'll do the same thing. That will not change. I'm just going to change these to pull from the correct cell. And then let's add in a row for the salvage value of 10,000, which we will get back at the end of the life. And that will be the same formula really as the working capital recovery. It'll be present value of rate of 8%, 8 periods, there's no payment, and there is a future value, but that should be positive. So and so we wind up with a net present value, assuming the salvage value as well as the working capital of $53,943. Okay. All right, last example I want to look at brings in taxes, because what we have done thus far is we've kind of ignored taxes completely. So everything is exactly like the previous example. $225,000 cost, $48,000 savings, $5,000 working capital that will be recovered at the end. We'll go back to the original 0 salvage value. Useful life 8 years, required rate of return 8%, but now we're going to assume there's a tax rate for this company of 20%. So investment and working capital, same, but look at years 1 through 8. Notice that the savings, when you take into consideration taxes, are less per year. So what I've done here is I have taken the 48,000 and multiplied it by 1 minus the tax rate. Because if we are going to have to pay taxes on that savings, then that will reduce the earnings per year. And so now we're looking at $38,400 per year. But keep in mind, depreciation. It's a non-cash expense, but it's a deductible expense. So we will actually have a savings on depreciation. So what I have done in this cell is I have taken the cost of the machine, divided it by the 8 years to arrive at annual depreciation, and then multiplied that by the tax rate, so that we effectively will have a tax savings, and that is an increase in our cash of $5,625 every year. And so again, my calculation is the same for present value. Both of those cash flows are annuities, so I took the factor from the present value of an annuity table for 8% in 8 years and came down to these two numbers. Working capital recovery is not affected by the taxes, so it remains the same. And then down here, I just did exactly the same calculation using Excel. And so this is present value of an annuity, just like that one. Okay. So taxes will play into it, and depending on your tax rate, it could have a significant impact.